Hi everyone, welcome back to the channel. If you're working in Luxembourg funds, whether in accounting, fund admin, or compliance, you know how critical CSSF reporting is. It's not just ticking boxes for regulators, its accurate reporting protects investors, ensures transparency, and keeps your fund's operations smooth. In this video, we'll break down everything you need to know about CSSF reporting, the key forms, timelines, best practices, common pitfalls, and tips to avoiding errors. By the end of this video, you'll understand how to manage CSSF reporting like a pro. Let's get started. This video is all about CSSF reporting in the Luxembourg fund market, from basic requirements to advanced tips for accuracy. The CSSF stands for Commission de Surveillance du Secteur Financier. It's Luxembourg's financial regulator, overseeing not just investment funds, but also banks, financial service providers, and other regulated entities. The CSSF's mission is simple: protect investors, ensure transparency, and maintain trust in Luxembourg's financial system. For funds, that means your reporting must comply with their rules, and any deviation, even small errors, can attract scrutiny or penalties. Why CSSF reporting matters? It's really for main reasons. First being regulatory compliance, that is, UCITS and AIFMD funds are legally required to report accurately. Non-compliance can lead to fines and other sanctions. Secondly is for investor protection. Transparent reporting ensures investors know the true value of their investments. The third one is operational transparency, which means accurate reports reflect how the fund is managed, including NAV calculation and expense management. The fourth one and the final one is reputation. Reliable reporting strengthens trust with investors, auditors, and regulators. So while it might seem tedious, CSSF reporting is a cornerstone of fund integrity in Luxembourg. Now let's look at what needs to be reported. Annual and semi-annual reports with financial statements. These are often audited and provide a full picture of the fund's performance. NAV reporting to the depository and sometimes directly to regulators. Depending on your fund, reporting can be under Lux GAAP or IFRS. Knowing which framework applies is critical. And finally, risk and liquidity disclosures showing how investments are valued, risk are managed, and liquidity maintained. The key point here is that CSSF expects accuracy, consistency, and transparency across all reporting. Timing is crucial in CSSF reporting. We have reports which we need to submit on a monthly basis, on a quarterly basis, or on annual basis. For monthly, NAV must be calculated and reported to the depository. This ensures that investors have up-to-date fund values. Quarterly regulatory returns, often including fund positions, risk metrics, and other compliance issues. Annually, complete audited financial statements, risk disclosures, and any other statutory filings. So what you can do is build internal timelines ahead of CSSF deadlines to allow for review, corrections, and final approval. Because late or rushed reporting increases the risk of errors, and you might as well be sanctioned in case of late filings. Common CSSF forms. The CSSF provides standardized forms for different types of fund. There's an AIFM form for alternative investment funds covering fund positions, risk exposures, and management processes. UCITS form for UCITS funds, including financial statements, portfolio holdings, and risk management data. Annual report forms, often audited, detailing fund performance, NAV, and expenses. Then you have the risk and liquidity disclosures, which detail how the fund manages market, credit, or liquidity risk. These forms can look intimidating at first, but most of the data comes directly from your accounting system and NAV calculations. Familiarity with the structure makes the process much smoother. To ensure smooth CSSF reporting, you need to follow the best practices. First, always verify that NAV and all fund expenses are calculated and classified correctly. Then apply the same principles month to month. Changing methods mid-year can trigger questions. Third, reconcile positions, validate fees, and double-check FX conversions. Fourth, ensure your annual and semi-annual reports clearly describe investment policies, valuations, and risk exposures. Following these best practices not only reduces errors, but also builds credibility with auditors and the CSSF. Even seasoned professionals make mistakes. The most common pitfalls include late submissions, that is, you miss the deadlines, which can lead to penalties or regulatory attention. Inaccurate NAV reporting, that is, mispricing assets or miscalculating expenses, which can distort the fund value. Misclassified expenses, that is, operating versus fund expenses, are incorrect. Incomplete disclosures, missing notes, risk explanations, or investment policies are not complete. Being aware of these pitfalls allow you to proactively prevent them. Some advanced tips for fund professionals here: use automated reconciliations to reduce manual errors. Schedule internal reviews before submission to catch inconsistencies. Cross-check NAV, fees, and positions against auditor and depository reports. Maintain CSSF reporting checklist for each submission. Keep historical reporting data handy for comparisons. It helps spot unusual trends. To wrap up now, CSSF reporting ensures compliance, transparency, and investor protection. Accurate NAV and proper expense management are fundamental. Stick to reporting timelines and follow internal controls. Avoid common errors and adopt best practices to make the process smooth. When done right, CSSF reporting strengthens your fund credibility and operational efficiency. If you found this video helpful, hit the like button and subscribe for more insights into Luxembourg fund accounting, NAV, Lux GAAP, IFRS, and regulatory compliance. Also, tell me in the comment section below which topic you would like next. Thanks for watching and see you in the next video.